Hi, my name is Innocent Mapanda. I hope I find you well. In today's lesson, we are going to concentrate on income statement and statement of financial position. Remember, income statement was also known as the trading and profit and loss account. Statement of financial position was known before as the balance sheet. So income statement and statement of financial position are the new terms that replaced trading and profit and loss account and balance sheet respectively. Right. So I have extracted a question from OCR, ACGC Accounting, Wednesday, 14 May 2014 afternoon session. Right. So the question reads, on 31 March 2014, the following information was available from the books of Elawards, a sole trader. Then we are given the trial balance from capital up to the provision for depreciation of computers. Right. Remember, a trial balance is a list of balances or a list of ledger balances that we normally use when preparing the income statement. Right. So we are given additional information below the trial balance. So when preparing the income statement, you have to take into account of those adjustments, note number 1 up to note number 10. Right. So I'm going to start with the income statement. The first thing when preparing income statement, you start with the sales. So you write sales, also known as revenue. Right. So I'm going to look the sales figure into the trial balance. You can notice that the sales are amounting to 510,000. Right. Second from the first at the top. So I'm going to write 510,000. Right. So after writing the sales figure, you have to check if you have what you call returns inwards. Right. Returns inwards, these are goods retained by the customers to the business due to unsatisfactory. They reduce sales figure. So if we look in our trial balance, we have sales returns, which are the returns inwards. So I'm going to less sales returns. So sales returns are amounting to 6670 or 6,670. So I'm going to subtract 510,000 minus 6,670. Then you get 503, 330. 503,330. So this figure is known as the turnover, or what we call net sales. Right. So from the turnover figure, we move on to the heading less cost of sales. Less cost of sales, or the cost of goods sold. Right. So the first thing to write under this heading is the opening inventory, also known as the opening stock. Right. So opening inventory is identified in the trial balance. Remember, we've got opening inventory and closing inventory. Opening inventory is the one which is given in the trial balance. Then closing inventory is given under additional information. Right. So I'm going to visit the trial balance. I'm going to look for the word inventory or the word stock, since stock and inventory are one and the same. Right. So in the trial balance, stock is amounting to 42,160. Right. Then you have to add purchases. You have to add purchases. Right. The purchases figure in the trial balance, third from the first or third from the top is 219,790. So I'm going to add the 42,160 plus 219,790. It gives you 261,950. Right. So after adding purchases on the opening stock, I want you to know that we have got two items that we less from the amount that we obtain after adding opening stock and purchases. The first item to be deducted are returns outwards, or what you call purchases returns. These are goods returned by the business to the supplier due to unsatisfactory. Right. So if we look into our trial balance, we can notice that the purchases returns figure is amounting to 59.60. So I'm going to less purchases returns 59.60. Right, so 260,1950 minus 59.60, you get 255,990. Right. The other component to be deducted is the drawings for goods. Drawings for goods are located under additional information. If you look at additional information note number 2, you can notice that Ella had withdrawn stock or goods at a cost of 6,440 from the business for her personal use. Right. So we have drawings for cash. Those are not deducted, or those are not part of the income statement. But drawings for goods, if the owner of the business withdrew goods for own use, we have to deduct those goods from the purchase amount. So I'm going to less drawings for goods amounting to 6,440. So it means that 255,990 minus 6,440, you come out with 249,550. Right. So after deducting those two items, we are going to add carriage inwards. Carriage inwards. Carriage inwards, it refers to the transport costs incurred by the business to deliver goods from the supplier's factory to the business or to the workplace. Right. So those transport costs incurred in delivering goods bought for resale are not treated as expenses, but they are attached to the cost of the goods. That's why we have to add carriage inwards on purchases. So carriage inwards are amounting to 2.1. So I'm going to add 2.1 on 249,550. So you are going to come out with 251,650. I hope you are listening, class. Right, then we've got a list of items besides the carriage inwards, which are also added on the purchases figure, and they are not recorded in the expenses account. They include railage inwards. If we make use of train, we call them railage inwards. Railage inwards are good as carriage inwards. They are also added to the purchases figure. Then other costs may include warehouse costs, packaging costs, import duty, customs duty. Right. All those costs that I have mentioned, including air freight charges, right, they are treated the same way we did on carriage inwards. They are all added to the purchases figure and they do not fall under expenses. So you have to take note of those items in your diary. Right, so after adding carriage inwards, I'm going to less closing inventory or the closing stock given under additional information. So additional information number 1, it reads, the closing stock as at 31 March 2014 was valued at 34,520. So I'm going to deduct 34,520 from 251,650. You get 217,130, which we call cost of sales. We call this figure cost of what? Cost of sales. Right, so I'm going to deduct the cost of sales from the turnover. Right, so I'm going to deduct 2 217, 130, from 503, 330. You come out with 286, 200, which we call gross profit. Why do we call it gross profit? Because we have deducted the cost of sales only, but we have not taken into account of other expenses. So if we then deduct other expenses from the gross profit, this is whereby you get your net profit, right? So from the gross profit, before you move on to the less expenses heading, you have to add what you call other income. We have got other income. Other income, it refers to both cash and non-cash incomes, which may include discount received, rent received, profit on disposal, or a decrease in provision for bad debts. Those items, they fall under other income. They increase the gross profit. So I'm going to scan in my trial balance to look for those items. Right, so from top to bottom, the first income that I have encountered is commission received. So I'm going to write commission. I'm going to write commission received. Right. So before you write 8710, you have to check if there is no adjustment in relation to commission what received under additional information. Sometimes you may encounter a statement which says that commission received amounting to maybe 500 are owing. It means that you have to add on the figure in the balance sheet. So from the look of things, if we look at our additional information, there is nothing mentioned about commission received. So I'm going to take the figure in the trial balance as it is, 8710. Then we have got discount received. Discount received, it refers to cash discount given to the business by the supplier, maybe for prompt payment or for bulk buying. You enjoy purchasing economies of scale if you buy or if you purchase goods in bulk from suppliers. Hence, they deduct a certain percentage on the total cost of the goods, which we call discount received. So discount received amounting to 4150. Right. Then another expense may come from the provision for bad debts. But provision for bad debts may result in an expense or may result in an income, depending on whether or not the provision is increased or decreased. So you prepare a table like this. You write provision for bad debts at the top. Then you write previous. Then you write current. Right. The previous, it refers to the provision for bad debts in the trial balance, or which represents the provision for bad debts for the previous year. So it is located in the trial balance. So we have to check the trial balance. Provision for bad debts, they are amounting to 1720. So I'm going to write 1720. So let's say you encounter a question whereby there is no provision for doubtful debts or a provision for bad debts in the trial balance. You have to write 0 on previous. Right. Then we move on to current. To calculate current, we make use of additional information. Right. Additional information number 5, it says that Ella is becoming concerned about a long-standing debt for 2.3, and he has decided to create a specific provision for this debt, in addition to a general provision of 3% of remaining debtors. So what you need to do, you have to write 2.3. You write 2.3 first, then you put your plus, right? So from the figure of debtors or trade receivables, remember debtors are also called trade receivables. If you look in your trial balance, you can notice that the debtors are amounting to 56,800. So 56,800. You have to less 2.3 first. So 0, 0. 8 minus 3, you get 5. 6 minus 2, you get 4. 5 minus 0, you get 5. So 54,500 are the remaining debtors after creating a specific provision of 2.3. So you have to multiply 54,500 times the given percentage. Right. Remember, in addition to a general provision of 3%. So I'm going to multiply 54,500 times 3%. 54,500 times 3%. You get 1635. So 2.3 plus 1635. You get 3935 as your current figure. Right. So if you compare the previous and the current figure, you can notice that provision for bad debts has increased. So it has increased by 2215. So an increase denotes an expense. Hence, we are going to write it under the heading of expenses. I hope you are listening, class. Right. So if you encounter a scenario whereby the current provision for bad debts is lower than the previous, it means decrease in provision for bad debts, and decrease is treated as income. But 2215 is an increase which reflects an expense. So it means that for the income, we are warm and dry. So I'm going to add 8710 plus 4150. You get 12,860. Then you add 12,860 on 286,200. On 286,200. You come with 299,060. Right. So there's no need to write, this is not gross profit, but we have added to the gross profit already. Right, so we now move on to the next heading, which is less expenses. Less expenses. I normally start with expenses which are found under additional information, so that we start with adjustments first. Right. So additional information number 2. We have dealt with it already. These are drains for goods. So the first adjustment is going to start on additional information number 3. Computers to the value of 2,230 have been purchased during the year. These were included in general expenses. So this is error of principle, where a capital expenditure of computer being purchased was treated as a revenue expenditure. So I'm going to write general expenses first. You write general expenses. Then you look at your trial balance. General expenses are amounting to 9320. Right. So from the 9320, I'm going to deduct 2230. Why? Because 2230 are computers. They are not general expenses. So they must not be part of general expenses. Right. So before you conclude the adjustment, you have to check under additional information if there is any adjustment relating to general expenses. Yes, there is adjustment number 8. At 31 March 2014, general expenses of 820 were owing. So it means that I'm going to add 820, applying the accrual concept. If any amount remains unpaid, remember when preparing income statement, you use accrual basis. So you have to add any unpaid amount or any outstanding amount or any amount in arrears or any amount due or accrued or owing is added to the figure in the trial balance. So 93.20 minus 22.30 plus 8.20, you get 79.10. So we are through with the general expenses. Then we move on to item number 5, the one that we have calculated already. We have noticed that provision for bad debts or provision for doubtful debts has increased. So I'm going to write increase in provision for bad debts. So they've increased by 22.15. Right, from there, we move on to note number 6. The amount paid for salaries each month has remained unchanged throughout the year, but remains unpaid for the month of March 2014. So, if you look in your trial balance, salaries are amounting to 88,000. 88,000, it reflects or it represents the salaries that were actually paid by awards, right? So additional information is alerting us that there is salary for March 2014 that was unpaid, and the salary is accruing evenly per each month. It means that the salary of January is same as the salary of February, which is same as the salary of March. So each and every month has got an equal salary, right? So 88,000, it means that it is covering 11 months. Since the additional information is alerting that in the last month of March, the salary of March, the month of March was unpaid. So, right. So what you need to do, you have to calculate the salary of the month of March that was unpaid, right? Remember, 88,000 in the trial balance is referring to the salary paid, and so it means that 88,000 is covering 11 months. Remember, in a year we have got 12 months. So out of the 12 months, one of the month was unpaid. So it means that 88,000 is equals to 11, right? Then X is equals to 1. So I want to calculate the 1 month that was not paid. So I'm going to use cross multiplication. X times 11, you get 11x. 1 times 88, you get 88,000. Then you divide both sides by 11. X is equals to 8,000. So 8,000 is the salary for March that was unpaid, which is going to fall under the balance sheet heading current liabilities as salary owing. I hope you are listening. So under expenses, you are going to write salaries first. Then you take the salaries in the trial balance figure, which is 88,000. 88,000 is going to be added by 8,000, the 1 month salary of March that was unpaid. Since whenever you see the word owing, outstanding, accrual, in arrears, amount due, you have to add. So if you add, you get 96,000. I hope you are listening, class. Then we move on to item number 7. Rent is paid quarterly in arrears, but the payment due for the quarter ended 31 March 2014 remains unpaid. It means that the last quarter rent of the last quarter was not paid. So what does it mean? What does it mean? Rent is paid quarterly. It means that rent is paid after each and every 3 months. Quarterly, it means that we are going to make payments 4 times in a year. Since a year has got 12 months, so it means that a quarter has 3 months. So it means that rent of the last 3 months was not paid. And so if you look in your trial balance, there is rent of 63,000. So it means 63,000 is covering the rent of the first 3 quarters. Remember, any figure or any expense that you see in the trial balance, it refers to the amount actually paid for that expense. So 63,000 is referring to the amount actually paid for the rent, right? So if the additional information is telling that the last quarter ended 31 March 2014 was not paid, it means that 63,000 is covering 9 months, which are 3 quarters. 1 quarter is 3 months. So 3 quarters paid, it means 9 months paid. So I'm going to calculate the rent that was unpaid of the last 3 months, which is the last quarter. So x is equals to 3, 63,000 is equals to 9. Then you do cross multiplication. So x times 9, you get 9x. Then 63,000 times 3, you get 189,000. Then you divide both sides by 9. So 189,000 divided by 9, you get 21,000. So it means that rent amounting to 21,000 is representing the rent of the last quarter, which was unpaid. So it falls under current liabilities as well in the trial balance. So how am I going to record rent under the expenses heading? I'm going to take 63,000 in the trial balance, then add it with the 21,000 representing the last 3 months or the last quarter which was unpaid. So if you add the two, you get 84,000. I hope you are listening, class. Right. Then we move on to additional information number 8. General expenses of 820 were owing. We have dealt with it already. Whilst insurance was prepaid 1920. So whenever you see insurance prepaid means we have paid in advance. So you have to deduct so that you'll be left with insurance which covers the financial accounting period, applying accrual or matching concept. So insurance, I'm going to write insurance, then you put open bracket, you visit your trial balance. Insurance in the trial balance is amounting to 8890. Then you have to deduct 1920 from 8890. So 8890 minus 1920, you get 6970. So this is how you adjust insurance. Then 1920, the amount prepaid, it falls under current assets in the balance sheet or in the statement of financial position. Right, we proceed. We move on to note number 9. Loan for 36,000 was taken out on 1 September. 50% of the loan is repayable 31 August and the remaining after 12 months. So it means that if you visit your trial balance, under loan there is 5% loan of 36,000. What it all means is half of 36,000 is going to fall under the heading of current liability since it is now payable within less than 1 year. So the other 18,000 will fall under long-term liabilities as it is going to be repayable after a period of 1 year. Right, but loan is not part of expenses, but we have to record loan interest. Loan and loan interest are different. Loan is not an expense, but loan interest is an expense. Right. So if you, for loan interest, I would advise you to record loan interest separately. Right. So you start by obtaining operating profit. Then you less loan interest from the operating profit separately. So for the loan, I'm going to leave it at the moment so that I start calculate the operating profit first. Then you then deduct your loan interest, and I'm going to teach you how you are going to calculate the loan interest. So let us proceed to other operating expenses besides the finance costs, which is the loan interest. Right. Then we move on to depreciation. I'm going to start with the depreciation of motor vehicles. Reducing balance method is said that you have to multiply the percentage with the difference of cost minus the provision. Right, so the costs of motor vehicles in the trial balance, which is fourth from the bottom, is 80,700. So cost is equals to 80,700. But the cost must be adjusted. There is not number. There is not number. This is not number what? There is not number 4. During the financial year, Ella Watts has purchased a new family car of 18,700. This was recorded in the motor vehicles in the business account. A family car is not part of business vehicles. So it means that I'm going to deduct 18,700 from 80,700. So 80,700 minus 18,700, you'll be left with the 62,000, which is the revised cost figure. Right. So the formula under reducing is R% times cost minus provision for depreciation or accumulated depreciation. So the percentage that we are using to calculate depreciation for motor vehicles is 25%. So I'm going to write 25% first, then multiply it by the cost of 62,000 minus the provision for depreciation of motor vehicles. So provision for depreciation of motor vehicles is given as 15,500. So 62,000 minus 15,500, you get 46,500. Then you multiply it by 25%. You get 11,625. So this is how you're supposed to calculate depreciation for the motor vehicles. Then you move on to depreciation for computers. I'm going to start by calculating the revised cost of computers. So the cost of computers in the trial balance is 33,000. But there is additional information, note number 3. Computers to the value of 2230 have been purchased during the year. These were included in general expenses. It means that these computers were not recorded in the computer account. So 33,000 must be added with the 2330. So 33,000 plus the 2230, you get 35,230. So 35,230 is the revised cost for the computers. So we are going to be using the same formula. Why? Because computers are being depreciated at 40% per annum using reducing balance method, which is also known as diminishing balance method. So R% times cost minus provision is the formula. So the percentage is 40% here. Then the revised cost after adding the computers which were treated as general expenses is 35,230 minus the provision for depreciation for computers is given in the trial balance at the end of the trial balance is 13,200. So 35,230 minus 13,200, you get 22,030. Then you have to multiply by 40%. You get 8812 is your depreciation. So we are through with additional information, but it doesn't mean that we are through with all expenses. After making adjustment to all expenses in the additional information, you have to revisit the trial balance and scan and check whether you have the remaining expenses which were not part of additional information. Right. So we have electricity. I'm going to take them in their order. Electricity amounting to 21,000. Then we have got motor expenses amounting to 8450. Then we have bad debts. We have bad debts amounting to 3460. Then from bad debts, what do we have? I'm sure we are through. right? So I'm going to add all the operating expenses. 7910 plus 2215 plus 96,000 plus 84,000 plus 6970 plus 11,625 plus 8812 plus 21,000 plus 8450 plus 3460. You get 250 double 42. Then you have to deduct it from the gross profit of 299,060. You will be left out with 48,618, which I'm going to name operating profit. Why? Because we have deducted all other expenses, but we have not yet deducted the loan interest. So operating profit refers to the net profit before loan interest, right? So after calculating the operating profit, you then deduct your loan interest. So loan interest is divided into two. We have the paid and the accrued, right? So loan interest paid is the one which is given in the trial balance. If you visit your trial balance, you can notice that there is loan interest just below the 5% loan. There is loan interest of 1350. 1350, it refers to the loan interest that was paid during the year. But remember, trading and profit and loss account, it doesn't deal with cash basis, but it deals with accrual basis. So accrual basis, it says that you do not have to record the loan interest that was paid alone, but you have to record the total loan interest that was supposed to be paid in the financial accounting period. So the total is then found by adding the paid with the non-paid, which we call accrued, right? So how do you identify the accrued, right? You make use of the 5% loan interest. Remember, the total loan is 36,000. Multiply it by the interest of 5%. So 36,000 times the interest rate of 5%, you get 1.8. You get 1.8. So what they are trying to say is, of the 1.8, which was supposed to be paid for that financial accounting period, Ella Watts paid on 1350. So 1.8 minus 1350, it means that 450 is the accrued loan interest, right? So if you add the two, you get 1.8, which is recorded in the income statement. Deduct it from 48,618. So 48,618 minus 1.8, you get 46,818. And 46,818, it denotes your net profit. So this is how you're supposed to prepare the income statement for you to get the 43 marks. I hope you are listening, class. Right. So for today, we are going to end here. Watch out for the next episode, whereby I'm going to proceed with the same question as we deal with the balance sheet or the statement of financial position. I hope you enjoyed today's lesson. Till we meet again, shalom.